For more on this story, we spoke to investment advisor Jeff Demaso, who says young people could see higher yield in real estate if they're willing to take a risk.
And then they look at bonds. And bonds are safer, yes, but yields are at record lows. So the yield on the 10 years at 1.65% right now. Locking in that type of return for 10 years without even considering inflation really isn't that attractive. So investors can look at real estate and they're getting some extra yield there. But there are some extra risks. There's questions about liquidity, and you have to have the right location. So investors are really getting pushed out there to try and look for yield is what's the attraction.
And of course, there are some risks. Now, there are other ways that investors can invest in real estate instead of just buying property, and that is by investing in real estate investment trusts or REITs. What is the longer-term outlook for REITs, and what are some of the risks with REITs?
Yeah, you know, REITs really have gotten a nice boost here from a housing market that's beginning to put in a bit of a bottom. And that could continue to support REITs moving forward. However, I would caution investors that there are some risks related to REITs. Historically, REITs have had a risk profile in between stocks and bonds. But over the past 5 years, we've really seen that relationship come apart. And REITs have been as risky, if not more so, than stocks. So in the financial crisis, when stocks were down 50% at their worst, REITs were down about 68 to 70%. And that might not sound like that big of a difference, but with a 50% decline, you need a 100% return to get back to where you were.
Okay, so perhaps for all these young investors, they are not seeing all that volatility. They're seeing more the yield, but they should be aware of that as well.
Exactly.
Now, one of the reasons that we're seeing a lot of young investors wary of the stock market is because they saw their parents badly burned. Do you think this is short-sighted of them, though?
You know, I do think it is a little bit. I think it's they're falling prey to looking in the rearview mirror when they're investing. 15 years ago in the bull market for stocks, everybody wanted stocks. They couldn't get enough of them. Today, we're looking back and we're saying, hey, over the past 15 years, stocks have actually underperformed bonds, and investors want nothing to do with stocks. Over the past 12 months, we've seen investors pull $75 billion out of stocks. At the same time, we've seen $270 billion go into bond funds. And this is over a 12-month period when stocks are up 25% and bonds are at record lows. So this type of rear-view investing is already hurting investor returns. Right,
and we're seeing that the retail investor is really shying away from the stock market, even though we saw those nice returns over the past few years. Have they missed the rally? And if they have, can they still get in now and make some nice returns, or is it too late?
But we don't think it's too late to get into stocks right now. In particular, we're finding opportunities in what we call battleship balance sheet companies. These are large companies. They've got strong balance sheets. They've got cash on the balance sheet. And they've also got a yield above the 10-year treasury often, plus they've got opportunity to grow. So examples would include household names like Walmart, Johnson & Johnson, Pepsi, McDonald's. And in particular at Advisor, we like managers like Matt Fruhan and Don Kilbride, who respectively run Fidelity Megacap Stock and Vanguard Dividend Growth as ways to play these type of companies in the mutual fund format.
Okay, so you really think large cap stocks better, look at the Dow components and look at the dividends.
Exactly.